Hey everyone, welcome back to Corporate Decoder. In this video, we will decode Mixed Martial Arts Group Limited's latest report, and let's just say things are getting interesting, like a surprise round in an MMA fight. Before we dive into the ring, if you love getting clear, no-nonsense insights from these corporate filings, make sure you hit that subscribe button and join our Discord community linked in the description below, where we break down more of these documents. You will not want to miss out. Alright, we are looking at Mixed Martial Arts Group Limited's annual report, a Form 20F, which is basically their big yearly update. This report is for the year ending the 30th of June 2025. Now, right off the bat, they disclose they are a non-accelerated filer and an emerging growth company. This means they are still growing and potentially have some breathing room with certain reporting rules, but it also hints at the challenges they might be facing. They have elected to use some of the perks that come with being an emerging growth company, meaning they might not be following all the newest accounting rules as quickly as larger companies. This is pretty common for growing businesses. This company, formerly known as Alta Global Group Limited, is building something called the Digital Infrastructure for Combat Sports. Essentially, they want to be the online hub for everything mixed martial arts. They are currently considered a non-accelerated filer. This usually indicates a smaller company with less than $75 million in public shares, or a newer one that hasn't met stricter requirements yet. Now, let's get into the juicy part, the financials. This is what tells us the real story of how the business is doing. Looking at their consolidated statement of profit or loss, we see a major trend. In 2025, they reported a loss after tax of over 26 million Australian dollars. For 2024, the loss was about 14.4 million Australian dollars. That is a big jump in losses, almost doubling from 2024 to 2025. Their total revenue for 2025 was about 1.38 million Australian dollars, a significant increase from around 562,000 Australian dollars in 2024. So they are bringing in way more money, which is great. But this revenue growth is being completely swallowed by their expenses. And speaking of expenses, look at this investor relations and corporate advisory expense. It shot up from about 160,000 Australian dollars in 2024 to a staggering 4.78 million Australian dollars in 2025. That is an increase of over 2,800%. This massive jump is largely tied to their initial public offering, which makes sense, but it is a huge chunk of money. Then we have share-based payments, which jumped from 4.5 million Australian dollars in 2024 to over 9.7 million Australian dollars in 2025. This is money given to employees and advisors in the form of stock or options, and it is a big non-cash expense. Basically, they are giving away a lot of ownership to attract and retain talent, which can be good, but it also dilutes existing shareholders. So you have revenues climbing, but expenses climbing even faster, leading to a much bigger loss before income tax of over 26 million Australian dollars in 2025. This is a trend that needs a serious turnaround for the company to become profitable. Now let's look at their financial position. As of the 30th of June 2025, they have a net liability position of over 1.38 million Australian dollars. This is a big shift from 2024 when they had a net asset position of over 2.5 million Australian dollars. So liabilities have officially overtaken assets. Their actual cash on hand also decreased from about 3.5 million Australian dollars in 2024 to just over 2 million Australian dollars in 2025. This shrinking cash pile combined with growing losses and liabilities is a major red flag. Looking at their cash flow from operations, they used over 8.3 million Australian dollars in 2025, which is slightly less than the almost 9.3 million Australian dollars they used in 2024. This means their day-to-day business operations are still burning through cash. They did get a good chunk of cash from financing activities, over 6.8 million Australian dollars in 2025, up from over 9.4 million in 2024. This comes from issuing shares, which is how they are keeping the lights on. They mentioned two public offerings, one in March 2024 and another in June 2025, raising millions of dollars. This is crucial because without this money, they would be in serious trouble. One of the biggest worries here is the going concern note. Their own auditors have flagged substantial doubt about their ability to continue as a going concern. This isn't just corporate jargon, it means there is serious uncertainty about whether the company can stay in business for the next year. This is usually because of recurring losses, negative cash flow, and insufficient funds. The report even mentions this directly in the risk factors. They need a lot more capital to keep operating, and getting that money might dilute existing shareholders significantly or be unavailable altogether. Strategically, the company is betting big on consolidating the mixed martial arts industry through technology. They mention a few core business units like Trainalta for training programs and BJJ Link, a gym management platform. They also talk about a future crypto and Web3 initiative, hoping to let users get paid to train. This is a very ambitious plan trying to tap into the rapidly growing combat sports fan base. Their strategy is to partner with gyms rather than own them, using technology to help those gyms grow. This sounds smart, especially if they can get more gyms on board. However, the risks are significant. Like many businesses, they are vulnerable to economic downturns. If people stop spending on non-essential things, their revenue could take a big hit. They also have a heavy reliance on technology, meaning cyber attacks or system failures could be disastrous, and they are exposed to risks from user-generated content on their platforms, which can lead to legal and reputational problems. Leadership's changes are also on the horizon. Aaron Links recently came back as Chief Financial Officer in July 2025. Then there are several director changes and appointments. Laura Sanko joined the board in July 2025, and Donald Trump Jr. was appointed as a strategic advisor in September 2025. Focusing on business development and investor relations, these appointments could bring valuable connections and influence, but it is too early to tell their impact. Overall, Mixed Martial Arts Group Limited is in a high-stakes game. They have a clear vision to revolutionize combat sports through technology and have managed to raise significant capital to fund their operations and growth. The revenue is climbing, which is a positive sign, and their partnership strategy with gyms like UFC Gym is a solid approach. However, they are burning through a lot of cash and have a long way to go to reach profitability. The repeated losses and dependency on continuous fundraising, highlighted by the auditor's concern about their ability to continue as a going concern, create a very risky investment profile. While the ambitions are grand and the industry is growing, the immediate financial health and the path to sustainability are the biggest question marks. They need to demonstrate a clear path to profitability and effectively manage their burn rate to survive and thrive. Now, what is your take on this filing? Does Mixed Martial Arts Group Limited's ambitious plan outweigh the significant financial risks? Let me know your thoughts in the comments below. If you found this breakdown helpful, smash that like button, subscribe for more decoder sessions, and most importantly, join our Discord community linked in the description for even deeper dives. Thanks for watching, and I'll see you in the next one.